Okay. All right, everybody, we're going to get started in a couple of minutes. We're just waiting for the last participants to come in, and we'll be getting kicked off right about 4:30. If you have questions, please get them loaded up. We tend to have a lot of questions all the way at the end, so some people get annoyed that their questions don't get answered, so it's best if you just put them in now. We'll try to work them in as much as possible.
And you can also send questions to my Twitter account at Peter Prudden, 2 Ds.
Slick. Peter, can you speak out loud for a minute, please?
Yeah, test.
I can hear him okay. Okay, we are at 4:30, so we are going to kick it off. Hi, this is Michael Camo from Minyanville. We are here with Peter Prudden. Peter is one of the most popular contributors on Minyanville. He's very, very bright. He's very, very handsome. You can follow him on Twitter at peterprudden.com. And we are here to talk all things macro. So if you have questions about bonds, currencies, commodities, oil, silver, gold, stocks, bonds, whatever, we're here to cover all that stuff, macroeconomics, international news, Italy, all that stuff. So we're going to get started right away. Next slide, Mr. Sadaka, please. Okay, who's Peter Prudden? Now, Peter is, you know, I feel like there's a lot of guys in the financial media today that don't have real trading backgrounds, people that just kind of, you know, they do random things, and then somehow they get involved with the stock markets through blogging and all kinds of things like that. But Peter Prudden's worked on, you know, at Jefferies as a trader. That's a big-time investment bank. He's also head of trading at Maverick Capital Partners. Now, if you don't know, Maverick is one of the biggest hedge funds in the world, so that's like real deal stuff. Also, Peter was a football player. He was a long snapper for the University of Minnesota for 4 years, and we're going to talk about that first because it's kind of an interesting position.
Sure. It is, yeah. I think the parallels between trading and specifically long snapping within the football game, strikingly similar in that as a long snapper, the biggest objective is to curl your emotions and stay focused on your objective. Whether the team is losing or the team is winning is really irrelevant. It's about staying focused, doing your job. So it's about keeping in check your emotions, which in trading is very, very difficult to do. Staying disciplined, over the course of the trading day, also very, very tough to do. The hardest thing I think a young or growing trader needs to learn is discipline, risk management, patience, and not losing sight of his emotional control.
Okay, you know, we've talked a little bit like on and off the air about the importance of a game plan. Now, like, what do you think is a good game plan for, you know, the average trader playing at home? Like, coming into each trading day, like, what should they be thinking about?
You know, generally, a few things. First of all, I don't pretend or act like I know everything in the world. So, I myself have a list of go-to analysts, whether that be fundamental, technical, behavioral, that I check in with on a daily basis to see what they're saying, either for self-confirmation of my own ideas or to try and think of something that I'm not seeing in the marketplace or in the economy from a bigger perspective. With that said, my gauges that I was taught growing up, banks, semis, copper, small caps, crude, those are what lead, and transports, I'm sorry, those are what lead markets in two ways. So I really focus on those. What are they telling me? Midway through the trading day, if the Dow's flat, slightly negative, and you're seeing a surge in the transports, not really what we saw today, but similar to what we saw today with the transports leading, market's going to rally the rest of the day. You're going to have a trend day up. So you need to have those gauges either in the back of your mind that you're constantly analyzing and asking yourself questions.
Okay. Now, when we talk about a plan, now, do you have like specific levels you're watching and all these different indicators? Are there, like, how readily do you adapt? What makes you decide whether or not to stick to an existing plan?
Absolutely. Again, let's use today as an example. So, from Monday to yesterday's low to today is really a bit of a round trip reversal. And so, we walked in today with a few ideas of near-term resistance in the market, whether that be 1505, 1508, 1515 up to say 1520. So my idea was, okay, yesterday below 1485 in that area, the game plan was to come in and start covering some shorts that I've had on as a hedge via the spiders, and pick up some longs, which I did. And then into today, it was more about, okay, I want to stay long, but I'm also looking to reevaluate and redeploy that active hedge. And so I have my levels written down, and as the market as we ticked up, I threw some shorts out there. I was a little early, so I had to pull back and kind of watch the market for a while. And again, as I said, the key indicators of the transports, they were rallying, and so that made me put the brakes a little bit on the market on my short hedge, sit back, and then as the day went on, as we went into say 15.15, that's when I started to get active again on the short side up until the close near 15.20.
Okay, let's take a step back for a second. Now, with all these indicators, I mean, it feels like it always feels like this kind of risk-on, risk-off market. In fact, Bernanke referenced that specifically. At this point, does it matter what you follow as long as, I mean, I kind of feel like whether you follow the Russell or oil or bond yields, does it really matter? I mean, is it really important to keep track of so many things when it kind of feels like everything's in lockstep? It is a great question. I do think it's those gauges are pivotal on a bigger platform. So, for instance, Todd has often taught me this: banks and semis lead rallies. You need those intact and uptrending for a bull market to have any type of legs. And so those are bigger term type indicators. Here now in the short term, there's a confluence of agendas, attitudes out there, whether that be here in Europe, what's going on in Japan with their central banking policy. So we're the post 07, 08 world, it's a different feeling, and you have to be concerned about an Italian bond auction and what's going on in Spain, and how is the 10-year and 30 years being received midday, whether you're just an at-home investor, passive, or you're an everyday trader. And to be honest with you, you didn't need to have that stuff at the forefront of your investment toolkit 6, 7 years ago. And okay,
so the world's changed.
Right, so then as a follow-up, do you think that that strong correlation is going to break anytime soon?
I do. And I think that will kind of lead into my thesis. A lot about what I want to talk about today is obviously probably what's on everybody's mind: short-term versus long-term. Okay, so let's cover the short-term of the market. Let's cover the bigger picture as well, so we don't lose sight of that. But I do agree with you.
Okay, so why don't we move on to your themes for 2013? Like, what are the things people really need to know as we're getting on to the end of the first quarter pretty soon? What do people need to be thinking about?
Again, like when I sat down and went through my themes back in late November, early December, and published this piece through you guys in December, the tone of the market, the mood of the market, the behavior behind the beast, quote unquote, it was different than year-end 2010, year-end 2011, and that when we talked a year ago, the fear was prevalent. It was wearing on people's faces. Everyone was scared. Equities, the euro, it was going to hell in the handbasket. And so that fear set up a great opportunity to be in stocks for most of 2012 with a few corrective dips in between. I didn't feel that way this December, and I don't feel that way right now. I felt like there was a mood of complacency, whether that's QE3 or the Fed. People are in kind of the driver's seat, very comfortable knowing that the Fed is there. But then again, we did have that shock to the system into year-end regarding the fiscal cliff. And so I wanted to tell people, okay, expect a similar type of rally out of the gate in 2013 as we saw in 2011, 2012. Sharp up move in the first quarter. And again, it felt like 1510 to me, 1550 was an area that could be achieved in the first 60 days, call it so, where we are right now, just shy of that. One, technically, there was a head and shoulders pattern on the market. Todd's pointed that out, pinpointing 1523. And also, the behavior of the market said that, yeah, upside, absolutely, of course, but let's not lose sight of the fact that we have a concerning earnings, calendar period picking up. Q3 earnings were abysmal. They're dreadfully awful. I think.
Okay. Let me jump in for one quick second.
Sure.
On the question of earnings growth, I remember during the last bull market, I mean, we also kind of heard very similar arguments that we were getting earnings beats on expense management and, you know,
Correct.
Favorable foreign exchange trends, and revenue growth seemed to perpetually disappoint.
Right.
I mean, how important is it really to get, you know, revenues going again?
You know, I think it's important. It shows that, you know, the business cycle is working. And, you know, right now I don't think it's fully functioning to the level of the market. And that's kind of why I want to be cautious here into this 1510, 1550 level. Based upon the fact that I think what you have here is a bit of a near-term divergence in the actual health of the economy. We saw that in the fourth quarter GDP numbers. We're seeing that in the next slide or two. We're seeing that in earnings estimates being revised down prior to the earnings period, and then as we've gone through the earnings period, it's gotten progressively worse.
Okay, so to recap.
So in the near term, I'm talking maybe the next 3 to 6 months at max. It's just okay. The equity markets have just had a phenomenal run from the post-November election low of 1344 in the S&P up till now. So again, a lot of what I try and do, one second, sorry, I'll finish. 1 second. A lot of what I try to do here is understand where we are in the trend. Okay, so again, from the end of November to now, where are we in that trend? It seems we're longer in the tooth near term. So that's why we want to lighten up a little bit. That's why I said, okay, into 1520, start selling some longs as I've said in the buzz. I've been very adamant on the buzz the last month is that we don't want to be putting on new positions here right now. Risk reward at 17 times multiple. You know, I don't really want to get excited about stocks. I want to pare back. I want to apply an active hedge, much like what Scott Rutler does with his work, is having a managed hedge. So, you know, over the first quarter, we've gone 1500 to say 1530. We worked into a hedge. Worked out of that hedge yesterday below 1487, 1485, about 148.90 in the spiders, and boom, we're back to the point where I want to have an active hedge on again. With that said, though, I'm passively looking for one-off type opportunities. So yesterday I initiated a position in Ford, 1215 to 1220, looked like an attractive price. It was coming into support. Again, Ford trades at a 9 times multiple, PEG ratio less than 1. And also, if you really believe in the housing recovery, you're going to believe in the auto recovery. Because if you think about workmen and workers going to commercial sites, housing reduced, they're going to be buying trucks. There's going to be a refresh cycle in that truck, which Ford in the F-150 is obviously a leader in.
Yeah, okay, we're going to move on to the next slide. So let us talk about the case for caution.
Can you go back to Apple for 1 second? I know I'm sure everyone.
Absolutely, everybody. I want to know about Apple. So please tell me. I own a lot of Apple. I need to know what should I do.
Okay, well, Apple is interesting. At this point, 1445-ish. I don't think it's a short here. We've had the opportunity to be short from 700, and definitely don't want to be aggressively buying the stock long here. You're seeing out of Tim Cook, whether it was the GS conference or the investor conference today, he's struggling to deliver a message of confidence. And the one thing that aside from innovation, product innovation, just talking about the psychology of the CEO for a second, he's being challenged by Wall Street. And, Steve Jobs never went under this type of pressure from Wall Street. He kept the shark at bay. He was very vague. We loved him because, we always knew he was going to guide down, but we were content and safe in the stock based upon the genius behind the machine. And Tim Cook doesn't give that impression, frankly. So they're in a figuring out process. And when companies are doing that, that's not really where you want to be buying the stock. So it's better to sit on the sidelines. I think it's a great trading vehicle, and going forward, it's going to be a fantastic trading vehicle. We had some opportunity to play it long against 440, 435 the last 2 or 3 weeks. Some people aggressively could have faded that 485, 485, 47 move on the GS conference day. Right now it's in my opinion, it's no man's land. My target has been for the last few months has been 375 to 425. So
okay, well, let me go for one quick second. Do you think Apple will determine the direction of the market? I mean, can we rally without Apple?
Yes, because shockingly to me, the way we held up in the market as Apple declined has been absolutely mind-blowing. It surprised me. I didn't think it was going to happen. So at this point, there is that disconnect, and I don't believe if Apple, I think if Apple were to trade above, say, 465, 480, I think that's a level that you can get long against and hold for a longer period of time. That's where that downtrend line that's been smoothly in place since the September top, kind of resides. And above that, I think you get a lot of people coming out of the work to chase on a pure technical basis. With that being said, if we lose 435, for whatever reason, whether the market starts coming in and Apple starts coming in as well, if we lose 435, I think it's going to be a quick trip down to 390, and that's where the value guy wants to get tasty and aggressively long. I think 390 to 360, if we see those prices, that's where you want to start buying for the IRA again. That's where you want to start accumulating the stock for a hold, and dip the toe in. But right now, I think as a trader, above 465, 480, I'm proven wrong, and you got to buy the stock.
Okay. Just want to remind everyone, if you have questions, feel free to put them in the Q&A. Peter has assured me he knows everything, so anything you want to know, just let us know. But we're going to have to move on to the case for caution. So, I mean, what should we be worried about? I mean, we touched on earnings season a little bit, but
right.
Just how bad was it?
Again, looking at the second bullet point on a BTIG, that's a stark contrast into the excitement, the euphoria that you're seeing on TV. Those are facts. I think a lot of times what you're seeing on TV is journalists, hyping the day's news. I mean, for instance, Doug Katz, they mentioned this today on Twitter. The euphoria that you saw on CNBC this afternoon as the market ticked up, it was a little mind-blowing because that's not really indicative of what's really going on. And so earnings are a near-term caution. I'm not saying, let's go out and get net short and sell the market and go to cash. That's idiotic. I think what I do is I'm not trying to make big, bold predictions like that. But so the earnings are weakening. With that said, we also have, the limit sequestered on Friday. At this point, we don't have a resolution to that yet. We're hearing rumors of conference calls and so forth. Very tough to trade rumors.
Okay, so let me ask you something else. If we all kind of know that earnings and the trend for earnings season hasn't been all that great, but is it good enough? I mean, purely from a fundamental perspective, is it good enough to just keep the market going?
I'm gonna say no, based upon this reason. Simply due to the fact is earnings season, and again, it's a confluence of indicators. It's not just the earnings. It's elevated crude prices. So we saw almost $100 barrel of crude in late July, early February. Very, very elevated for a seasonality perspective. So that's going to strain the consumer spending. We saw obviously the negative GDP growth in the fourth quarter. You can spin that any way you want to. It's there, and it's in the back of our minds. With that, the payroll tax holiday being ended. So again, the consumer's getting hit. Companies aren't really performing to the level of 1,500, 1,550 in the market. Very similar to what happened in the 09 bottom and the October 4th low in 2011. The earnings of the negativity didn't really reflect what was really going on. I thought the economy was working better, obviously, than the death case scenario in March of 09. And again, the economy was working better in October of 2011 versus quote-unquote actual price. And so maybe the case of caution is a short-term mean reversion. Whether that is on the S&P, I don't know. That's my take on it right now.
Okay, what about all the stuff in Washington? I mean, I kind of feel like and frankly internationally also, that we keep kind of going from one big headline crisis to the next, whether it's the big mess in Greece and Spain, and then in Washington we've had the fiscal cliff, the debt ceiling, the sequester and all that garbage. Frankly, I've tuned it out at this point, but like, does any of that stuff matter?
It does, because I've written about this again on the Buzz product for Minyanville over the last year and a half, and that the first TARP vote, which failed, that was fool me once, okay? Shame on me. When Congress missed it, and the Dow absolutely fell apart. Second was the debt cycle, the debt hiking, the debt ceiling level, I'm sorry, in August of 2011. Shame on us for believing that Washington could actually come together, do what they're there to do, which is find compromise and take care of its citizens and the future of the country. I know it's a little bit bigger than we want to get into, but with that said, look what they did with the fiscal cliff. Granted, it was the absolute 11th hour, but they came together and the market rallied. So, one of the canaries in the coal mine of this quote-unquote bearishness that I'm aware of. I'm not overly bearish at these levels. If we were to go up 40 points in the S&P, that probably might change. But if Washington can get out of the way and get out of the market's way, this market will rip, and higher. I mean much higher. So that is a big headwind, whatever you want to call it, that's staring us in the face, and that to this point really hasn't gotten out of the way. So it's something that we have to have in the back of our mind, is that God knows what they're going to do in the next 48 hours. It's going to have an impact on the market whether you want to or not.
Okay, since we're on the topic of government, let me ask the first question is, like, how big of a factor has QE been in keeping the market up? And if that all goes away, what's going to happen?
That's the million-dollar question. And I think Michael Gaid, another fellow Minyanville contributor, spoke about that last week I believe on CNBC, when he said the absolute worst thing that could happen is having annualized GDP growth, say at 1.5%, 2.5%, and the market trading at 1,600. That is the worst case scenario, and that's kind of what I don't know. I mean, I think that's not what Chairman Bernanke's intentions have been. He's obviously been forcing hands into the equity markets, which, whether you want to disagree or agree, it's happening. But if you pull up a chart, the S&P actually saw this this morning from one of the research notes that I read, and you pinpoint where QE1, QE2, and QE3 started. They were all market bottoms. And if you look where QE1 ended and QE2 ended, they were market tops. And they were 8 to 15% corrections type tops. And so that's the question, is when does this end? Well, Bernanke's come out and basically said it's not going to end. And that's been the shift in QE3. It's tied to employment. It could go. We don't know. So that really is the quote-unquote bubble case that's probably staring us in the face. But with that said, when does the music stop? Nobody knows. I think it's one of the things we have to keep as an outlier.
Okay, another question coming in. Are there any particular intermarket relationships you find valuable as an indicator? And let's try to keep this quick because we still have some slides to go to and we want to get some more questions. So very quickly, like anything intermarket that you really look at that's important.
Correlations. I think correlations are breaking down. I think correlations have about a 9-year time horizon, and then they kind of find a way to kind of whittle away and be less relevant. So,
okay, all right. Well, let me ask you a follow-up then. Should we be looking for a specific break for two things to pull apart from each other, like something like that?
Absolutely. I think the best way to describe the market that's going on right now between the bond market, between gold, equities, is this coil, and that it's spring-loaded. The market's spring-loaded, gold, bonds, it's all together. And so, but it's on a much bigger scale. So to say that it's going to happen in 2 weeks or 2 years or 2 months, nobody knows. But what I'm seeing is that gold, from the September high in 2011, has been a worthless asset to me. Why do you want to be long gold when there's so much more things out there to buy and be long, whether that's a currency, that's a commodity, that's an equity. You know, if you were early in the game in gold, and I'm talking 2002, 2003, 2004, and if you caught the technical breakout in April of 2009, that went from 888 to say 1900, that's a great trade. Move on. And you know, so I don't like gold. You know, bonds, I don't know why you'd be sitting in a bond right now. It doesn't make any sense. You're not getting the yield. You know, investors can debate all day long whether it's in a bubble or not. You know, that makes for great theater, but you know, I took out a short rental on the bond market via the TBT yesterday.
No. The deadliest trade ever is the TBT trade.
You know, and so for right now, it's a trader. You know, I was buying the stock at 64.50 and below, and you know, it closed up 65.78-ish, I believe. That's a fantastic trade for right now. At one point, that trade will work on a much bigger scale. When, I don't know, but it's that shifting in the wind. You can kind of feel like it's happening. So you know, if we see a gold breakdown, if we see a bond breakdown in terms of yield going higher, if we see an elevated dollar and crude starts to tick down, you know, I think that's very bullish for the equity markets. And you can't deny that. Although one of Todd's golden rules is that
I will deny it, actually.
Okay. On what time horizon?
Oh no. My question is more with bonds. I was just screwing around, but
okay.
For me, the big thing with bonds is for bonds to really get weak. Is it going to take like a what do you think is more likely, like a big bad event in the bond market where people want to flee bonds, or like legitimate economic strength, if that's even possible?
You know, clearly by what we're seeing in the last 2 quarters of earnings, what we're seeing in recent GDP growth, it's not going to be economic strength that's going to drive a rotation trade. What it's going to be is S&P 500, and again, this is probably my quote-unquote stop out for being bearish. If we see the S&P 500, again, I'm playing theory here, you know, close above 1575 on a multi-week basis, chances are that we are in a new secular bull market, and that so you'll see a chase trade. You'll see people pour out of bonds. You'll see people, you know, sell gold and chase stocks. It will happen.
Okay, so
I'm not saying I'm expecting that, but that's one avenue of how we would see that quote-unquote rotation. It's just pure chasing. The other, which we'll get to, is my belief that we could potentially, based upon the caution items I've been putting up there, a weakening consumer, fragile earnings environment, fragile economy. You know, these are things that if we saw, for instance, a 10+% correction, I'm open to it. I'm not dedicated to it right now, but I'm very, very open to it. You know, I think what you see there is you see people, again, I got fooled again. I try to chase 1,500. I try to chase the market highs. I got excited by the headlines. You can't deny it. Barron's is printing it. Everyone's printing it. CNBC's is talking about it. Everyone's bullish. Everyone's very excited. And if we saw that 10+ type correction, what Todd has laid out happened in 2003, after a 7% move in the first 60 days, we saw 15% correction followed by a 40% reversal higher. I think that could very well happen here, because I think if investors get fooled again, they'll be done. They'll be disgusted. We saw the cracks of that happening this fall with the Bill Gross comment about dead equities are dead. We saw some headlines on Bloomberg saying, you know, equities are not the place to be based upon trading volumes and so forth. So, you know, if we see a correction north of 10%, I think you have to heavily buy it, heavily buy stock.
Okay, so one more question very quickly. As far as the individual investor goes, we've seen some indication that there's been a little bit of a return. We've seen some positive, you know, inflows into equity mutual funds. Like you saw, online trading volumes has been ticking up a little bit. Very quickly, where do you think the S&P has to go to really get people involved again?
All-time highs. All-time highs, and it has to hold there. So is that 1575? Is that 1600? I don't know, but they have to chase. People love a chase, right?
Okay, so what are we?
Back when you were chasing girls in college, that was exciting. It was invigorating.
Peter, it hasn't stopped.
I'm going to say people love to chase things. So, you know, for me and for what I try to do is I'm a value hunter. I want to find the contrarian trade. So for me, the best possible outcome is that we get hit with a 15% correction over the next 8 months, and you can buy that and allow others to chase it. Maybe that's what we saw in June. Maybe that's what we saw in November and end of December. I don't know.
Okay, let's talk about sentiment. We have the chart on the screen. You know, sentiment. Most indicators seems that it's on a bit of an upswing. Pretty much everything you look at. Do you think it is room to get more positive from here, or is pullback kind of inevitable?
Well, so on this AAll Bulls chart, you're seeing 3 lower highs on the actual sentiment versus 3 higher highs in the actual S&P cash index. And so there is a bit of a quote-unquote divergence. So you can be making the case that we're making the 3rd lower high in bullish sentiment here right now, followed by a 3rd higher high that potentially could lead to a pullback. I'm very open to that. Some of the other sentiment indicators I'm seeing is it's the highest since 2000, it's the highest since this, it's the highest since that. They're everywhere. You know, that's something obviously to be cautious on in the near term. You know, one of the things people have been talking about are investor inflows, and it was a record month in January. Well, great. So 29 came into the market after, I don't know, it's 400 billion, trillion came out of the market, whatever the number was, over the last 4 or 5 years. So 1 month doesn't start a trend, but it's something to be aware of. Okay,
we have another question. If the market corrects, will gold rally?
Tough question. That's one of the questions that I'm trying to answer myself right now. You know, sentiment is so low that you could see an uptick. I think if you're going to be long gold, short GDX. I want a pair trade in that. I'm bearish on the GDX. I'm bearish on the miners. You know, there's technical reasons, and I think a push back into say 40 to 41.50. I think that's a great opportunity to sell a bounce rather than try and buy the low. So again, you know, gold I don't really have an opinion on right now, to be honest with you. It's hanging on by an absolute thread. It could very, very well push through, you know, where it's 1,600. It could easily push you 1,540, 1,520, and be on its way down to 1,400, 1,100. I don't know. I think again, the two-way easy trade in gold has been made, and this is just more or less choppy noise.
Okay. A close friend asks, "Are you happy that Maker's Mark didn't water down their whiskey?"
Tremendously happy. Yes. You know. Always enjoy the Maker's Mark and Ninja Roll with the lime. It's a gentleman's drink for a guy like me in the backyard. It's fantastic.
Okay, cool. And thank you, Minion BP, for that very insightful question. So let's move on to the you know, we have a sub-zero, you know, city surprise economic index. Mm-hmm. So like, tell us what we're looking at here.
All right. So it's fairly obvious. On the bottom, you actually have the actual index overlaid with the S&P cash above. You've seen clearly every time the market finds a top, somehow, some way, the Citigroup index finds a way through zero. So the key component right now is, again, is this April 2012? Is this June, July 2011? Or is this December, November 2010? When, as you can see, with a quick dip below zero, followed by a bull flag in the S&P cash with an off to the races continuation. So at this point, I'm using this as a negative tool and something that's telling you that there is a divergence going on. It's cautious, and it's something to be aware of.
Okay. All right, we're going to move on. Let's talk about the Australian dollar versus the S&P 500.
Beautiful. Another divergence. We saw this last spring. There we go. So the first box highlighted was that divergence that occurred last February, March, and shortly after the S&P crept up and caught up with the Aussie dollar and traded lower. So we're seeing that once again. It's a rather large divergence, not minimal. So, you know, it's more bearish than bullish lean. So again, it's one of the things I'm looking out there. And what I'm trying to do is I'm trying to find where is the wind blowing? What is that direction telling us to be cautious or to be optimistic of? And so, you know, on the flip side, we saw this type of environment screaming positive divergences last June. You know, I believe Michael Gaid, a great colleague of ours, he and I penned an article towards the end of May in 2012 saying the S&P 500 cash could go to all-time highs. And here we are. And, you know, he's obviously changing his tune. I support his stance. I am changing my tune, albeit a little bit slower, but then again, he's a much smarter guy than I am, so he's probably aware of much larger things than I am looking at.
Okay, so on a related note, I feel we had a very brief discussion about this, but it feels like this currency wars. We have you know, everybody, you know, Japan especially wants to weaken their currencies to help boost their exports. Very quickly, is there a winner there, or is this just bound to end in disaster?
It seems that so many eyes are fixated on this currency war that I don't see how you know, granted, the fundamentalist is going to say, well, the massive printing by monetary banks across the globe is going to lead to just, you know, currency devaluation. That's the fundamental broad-based take. I would counter that with saying that the fact that the mom and pops at Starbucks are talking about a currency devaluation of the U.S. dollar, you know, that tells me that be on alert that that might be something that could work against us in the near term. And again, if we're going to go back to a bull market, a strong dollar has been associated, strong dollar, weak commodities, weak crude oil prices have been associated with bull markets in the past. Sure, you can say the divergence occurred in 03, 04 in that time period going forward. But again, I would argue that we've not been in a bull market since 2000. This has been a secular bear market. And so, again, the shift in the dollar, if we see dollar higher, you know, granted, lower commodities in the near term could be a headwind in the market. It's a bullish indicator for the consumer.
Okay, so speaking of a secular bear market,
sure.
Is this it? Is this the end of the road for that?
So I think so. I think this happens in the next, you know, whether it be 6 months, 18 months. You know, this chart I've used as a roadmap for the last 3 or 4 years, and this hasn't been updated for, I think, since September. So if we look at the white channel within the larger red channel, we are obviously higher than that channel now. So to me, that's very bullish. If we're going to base above this channel that we've been caught in and kind of consolidate between the higher band of the white channel and just below the lower band of the red channel, and over time, and just consolidate, that has to be considered as being bullish. With that said, as you see that I have the E wave mark there lower, which is about a 15 to 20% correction. That has been an outlier of mine. You know, I've had a bearish bias, although been bullish on the market overall for the last 2 years. It's one thing that I'm looking at. So when you think about secular bull markets, or I'm sorry, secular bear markets, they end in sideways frustration. And I have a slide coming up talking about the distaste for stocks being seen across the marketplace in headlines. And so
okay.
What we want to see here is we want to see this E wave, whether it's happening right now, whether it's already completed. We want to see it just a flat sideways chop that frustrates everyone. And really, it's the path of maximum frustration for bulls and bears. And that's why, you know, if we do see a correction north of 10%, I don't think the retail investor at home is going to have a very tough time shorting that move. It's going to be very, very difficult. I think it'll be very choppy, very chaotic, much like we've seen in the market this past week. Up moves, down moves, very confusing, very hard to get hold of. Confusing for me. So, you know, in my gut, I think that's there. I think this thing ends this year or into 2014. I would love to see a choppy zigzag move lower to finalize and put this thing to bed. But again, I'll respect higher prices.
Okay, we got a very good question here. I recognize the name. I don't know if he wants his name said out loud, so I won't. But are there any like high-yielding investments that you like right here?
You know, I don't trade high-yield junk. So I don't. I read a great, thoughtful piece by Bill Gross today in his monthly letter that I think came out today, talking about the narrow spread gap on high yield. I'll leave it to him. He's the expert.
Okay, but what about like dividend yielding stocks maybe? Like, how do you feel about that?
Great question. I think if you for instance, Boeing is a great example. Scott Rutherford talked about that's one of his stocks, 2013. You've seen, in offhand, I don't know the yield on stock. I would say it's probably north of 2.5%, 3%. But you've seen this news that it's just been beaten down the last 6 to 8 weeks on the Dreamliner news, and it's in stride. And that's a prime example of a great dividend, great defensive stock that's pushing on 78 resistance. And you tell me where the next level of resistance is. Is it 100? Is it 120? So
okay,
that's one example. The banks, right now, I've seen I'm thinking that there's a rotation going on that's happened out of the money centers into the regionals, based upon we're seeing M&A activity pick up. So maybe there's speculation. Obviously, I don't know the nuances in terms of what's going on, how the Fed's governing the banks, but you could see some M&A activity pick up in the regionals.
Okay, we got another good question. So let's keep this very quickly. We're gonna have to blaze through the rest of the slides. We're running out of time. But this 10–20% correction you're talking about? It's possible. Do you see? Is there a catalyst for that, or do you think it's just like natural cycle of the market?
The event is always unknown. I mean, we can point fingers and say it could be. Again, this rotation out of fixed income, it won't be smooth. So for the individual that says, okay, fixed income, bond investors are going to gradually just rotate and go into equities, that's not going to be a smooth ride. That's going to be very bumpy. You tell me if we are quote unquote in a fixed income asset bubble, you tell me the last time, the housing bubble, the equity bubbles, the dot-com bubbles, how do those unwind? Not very well. So clearly, equities will see some sort of gyrations from that if that was to occur. That's a possible outlier. Am I saying?
No, but do you see a catalyst that would cause the decline, or is it just garden variety pullback?
Garden variety pullback hasn't really happened the last 4 years. It's been these violent news-driven snaps, like you're suggesting and insinuating. It could be something out of Europe. I don't know. It could be something out of Washington. I don't know. Okay,
so all right, let's move on. So, you're pointing out some interesting parallels between the World War II period and today. Mm-hmm. So let's very quickly go through, what's similar between 1941 and 2008.
This is a very loose analog. I'm trying to bring together fundamentals, Fed policy. Can you go back to slide 13 for a second? Is it possible? Perfect, thank you. So I'm trying to put together actual market pricing of the stock market, the technicals, the fundamentals, and Fed policy and behavior. So I'm trying to bring all these together and find a story. And so, in 08, in September of 08, Warren Buffett labeled the ad environment as the economic Pearl Harbor, and I think he was exactly right. So we saw this economic event, like a Pearl Harbor event, in 2008. And from 41 on, I think, 41 to say about 44, 46, I think we've seen that kind of take shape in that, it's this negative feedback cycle. It's this fear cycle. People don't want to spend. People don't want to invest. If you don't spend, if you don't invest, how can you grow the economy? You can't. It's just, it's a self-fulfilling prophecy, and it just brings on more fear. And so the fear has elevated. We're all seeing it. Whether you want to admit it or not, your gut is fearful of the economy. It's fearful of the markets. It's fearful of Europe. So there's so much fear built up in us that the social mood is at zero, much like Pearl Harbor. Again, we were going to lose the war in 41, and I think you can make an argument that for the last 3 years, people have been debating the Fed, the economy, that we were going to lose the war, the credit war, and that the quote-unquote doomsday scenario has been coming. A lot of bears have been saying that doomsday is coming. I don't see it.
Okay. All right, we're gonna skip along to slide 18. Just so people know, if you want the slides, you can contact us, and we will send them over to you. But it's a little bit redundant with some of our prior discussion. We have a slide on death of equities. We've kind of talked about that stuff. So we're going to skip ahead a little bit so we have some time for a couple more questions. But so broad-based recovery, you think it's possible? You think it's likely?
It's slowly happening. So again, we're talking about the near term. What's going on in the near term? There's some caution signs out there that we have to be cognizant of. But at the same time, let's not lose sight of the big picture. And I think as the big picture slowly, this is a big moving ship that's slowly turning itself in the right direction. And you're seeing it in housing. I mean, today, last week, existing home sales numbers up 9% year over year. Prices up 12% year over year. As a real world example, my wife and I went house hunting this summer. From June, we started looking at houses, very limited inventory. And by the end of September, the inventory was depleted. Homes available are very sparse. And with that said, the houses that we were going after were receiving multiple bids. So 2, 3, 4, 5 bids on a single home. You haven't seen that since 05, 04.
Okay. So you got who are you talking over there? Like the cat or something?
It's a guy next door in the office, next door.
Okay, so
housing picks up. You've got this millennial generation, guys like myself, like you, like Michael Sadaka.
Please don't call me a millennial. I don't like that label, actually.
I'm sorry, but you're like the golden age individual. You're hungry, you're aggressive, you're smart, and you're willing to take risks. And that's what builds an economy. People like that. So people are out there. It's a huge generation compared to the boomers. Or I'm sorry, the extras.
Yeah, I don't know. You got the interest. I mean, a lot of it seems flimsy. I mean, a lot of the, kind of middle class jobs that, like my parents had, are completely disappearing. And I think you make an interesting point about like manufacturing coming back. Because the increasing cost of overseas, I mean, we're seeing like Apple talking about that, but I mean,
Caterpillar,
a lot of these manufacturing jobs are going to be done by robots. I mean,
correct. No, I agree with you. I think it's a very small piece of the puzzle. I'm not going to comment on President Obama, but he's often highlighted and spoke of fixing our roads and our bridges and our levees. And I don't think that's not what brings us back to the golden age of a flourishing economy, of a self-sustaining growth cycle. But it's a piece of the puzzle, and it has to be there. I think the millennial generation, they're smarter, they're innovative, they're willing to take risks. Obviously, throwing in technology and the adaptation of the internet age and social media, that growth cycle is going to look differently than it did 60, 70 years ago.
Okay, I mean, there's, I see positives and negatives to the growth of technology. There's increased productivity, but at the same time, there's friction. Things don't transition over smoothly. People that were in well-paying jobs can't always, they don't always adapt well to the environment. But net, do you think it averages out better for the economy?
I do. I think taking a step back in a little bit different direction than what you're talking about, if you look at the collapse of Wall Street jobs have been absolutely decimated over the last 4 years. And it's forced people to go out and find their passion, a different calling in life. So, you're hearing of people quitting their jobs and opening a bakery. So that bakery starts being successful, and all of a sudden she's got 4 or 5 different employees. It's those types of innovators, those risk takers, people that are turning different directions, of course, in their past, that's going to push us forward. So we need more risk takers.
Okay, I think that is just going to wrap us up. Everyone, thank you for attending. If you're interested in the slides, we're going to make them available to you. Again, you can follow Peter Prudden on Twitter. If you have any feedback, please feel free to email us. If you have any market-related questions, we're always happy to help. Any little thing that might be on your mind, why is the stock going up or down, why is gold doing this? We have a lot of connections. We'll always help people, even if you're not a Buzz and Banner subscriber. So again, thank you very much, and we will see you soon.
All right,
and
thanks.
Peter, thank you very much for your time.